Okay, welcome back to the trading desk. We're going to move on to our next driver now, and we're going to start looking at interest rates. But before we move on to interest rates, let's summarize quickly everything that we've looked at so far in terms of our drivers. We've looked at surveys and we've looked at M2 data. Now, when we look at surveys, were leading indicators. And we mentioned also that M2 was a leading indicator. However, we need to always think in the back of our minds how the flow of prediction and reaction works here. Because M2, although it's a leading indicator because it affects forward moving the coincident indicators and also potentially other monetary and fiscal policy, in our bigger picture, it is a monetary lever, and it sits on that right-hand side of our bigger picture process and how we look at the overall prediction and reactionary process in terms of the flow of drivers when predicting inflation and deflation. So we have to remember that M2 is a monetary lever, and central authorities like the Fed are actually using it as a reactionary tool when they're looking at leading and coincident indicators. However, when M2, the lever, is pulled, M2 is a leading indicator to what will happen to those in the future. So they actually both feed off each other. So that's very important, because now we're moving into our next driver, interest rates, and interest rates are actually lagging indicators. So they are reactionary and they are lagging to the overall economy in terms of what's on the left-hand side, leading indicators, and what's in the middle, coincident indicators. So you have to be very careful in terms of distinguishing between monetary levers like M2 and interest rates. So again, just bear this in mind and try to keep always in the back of your mind the overall map of how this works in terms of leading drivers on the left-hand side, predicting coincident indicators and central authority reaction. On the right-hand side, the levers, so what the reaction will be, and distinguishing between these levers themselves, and then also the coincident indicators in the middle that are lagging the leading indicators themselves, but are affected also by policy. Now, we looked earlier in the foundation section briefly at the Fed funds rate, just to get an understanding and a solid foundation of that understanding, so we can now move on and properly analyze it. And in the bigger context of what we're trying to do here, the whole process we're going through, remember again, is the static absolution principle. We're trying to get a full understanding as to whether the currency applied here as the US dollar, the currency is losing or increasing in value in absolute terms. So when we look at interest rates, as well as M2 and surveys, we have to just bear this in mind all the time. And now going into interest rates, we take the same approach. We look at it very objectively, and we look at it endogenously with using a static absolution principle. And what we want to learn is basically the best way to analyze interest rates historically and how we scorecard interest rates using that historical information. And again, we're going to end up looking at what is normal in history and what is abnormal. So let's go over to the computer screen and start working out how we analyze interest rates and how we actually go about scorecarding them, so we can put this driver into our overall analysis and try to predict inflation or deflation, or gauge inflation or deflation using our scorecards, and therefore working out whether the US dollar is potentially increasing or decreasing in value on an endogenous absolute basis. Let's go over to the screen and I'll see you on the other side for a conclusion.
Okay, so welcome back to the computer screen. What we're going to look at now is the next driver on our scorecard in the endogenous analysis, which is interest rates. Now, interest rates we looked at earlier in our foundation area of the video series, and we discovered that interest rates aren't really classically set by the perception in the way they are set. They are actually set by a market, and the market clearing rate is basically the level at which the central bank, and in this case the Federal Reserve, targets or sets interest rates. And if, for example, the Federal Reserve comes out and says they want to target an interest rate or set the interest rate at a certain level, basically what they're saying is they are going to intervene in the interbank market and manipulate the rate to that level. So the interest rate in the US as set by the Federal Reserve is called the Fed funds rate. And what we can do is we can obtain the data publicly by going to the Federal Reserve Bank of St. Louis again, and we go to the URL, which is on the page here. The level of interest rates, the direction they are heading, and the speed and the magnitudes of interest rate changes really are an important determining factor in our analysis of the US economy and all economies, and when we're trying to predict the potential value of a country's currency. And as we just went over again, the Fed funds rate is the interest rate at which depository institutions trade federal funds. So balances held at Federal Reserve's banks with each other overnight. And a bank, as we discovered earlier in the video series, with excess reserves basically lends to another bank if they have a shortfall in reserves. And this rate that the borrowing bank pays to the lending bank is the determined rate by the two banks, and the weighted average of all these rates amongst all banks trading with each other is called the Fed funds rate. And the rate is determined by the market. However, the Fed, through what they call open market operations, basically influence the rate in order to reach their target. So the Fed funds rate, the prevailing market interest rate, is therefore the price of money. So the price at which money is borrowed and lent. So when we're analyzing interest rates as one of our drivers, we always have to keep this in the back of our minds, as in that it's a price of money as set by the market rate, and a rate at which the Federal Reserve wishes interest rates to be and manipulates them to be that price. And also on top of that, the definition of the price of money, as in the price at which money is borrowed and lent. Now, the mechanism by which the Fed manipulates the prevailing Fed funds rate is by the buying and selling of government bonds. And if the Fed wants to decrease liquidity, they basically sell government bonds, and this creates a withdrawal. So money comes out of the system. And what this does by way of the mechanism is this raises the Fed funds rate because banks have less liquidity to trade with other banks. Money and liquidity becomes basically more scarce and is therefore more in demand. Now, the opposite holds true as well, where if the Fed wants to increase liquidity, they buy government bonds, thus injecting money into the system. This has the effect of lowering the Fed funds rate because banks have more liquidity in order to trade with when trading with other banks. And therefore, money and liquidity becomes less scarce and is more in supply. Now, the FOMC, the Federal Open Market Committee, they meet 8 times a year, and they basically meet to determine the federal funds target rate. And the Fed funds rate basically influences, through the market mechanism, longer term rates and products such as mortgages, loans, and savings through the banking system. And all of this combined basically influences consumer spending, so 66% of the economy, and business spending, so 34% of the economy. And we looked earlier in our surveys that the two key main bodies that make up the private sector are consumers and businesses. So the supply of money through the mechanism of interest rates, through the banking system, and the Fed using interest rates as a tool to do so, overall is a very important driver to our endogenous and overall scorecard analysis when trying to predict the value overall in an endogenous sense, the value of a country's currency. And from our knowledge that we picked up in the foundation section of the video series, and also so far in the idea generation phase of the systematic process, the knowledge that we've picked up, it should be pretty obvious as to why this is. Because when we're looking at injections and withdrawals into and out of the system, respectively, what we're trying to do here is again predict inflation and deflation, and thus the value of a country's currency in absolute and in relative terms. Here we're looking at it in absolute terms, so in an endogenous sense, and later when we look at our exogenous analysis, we'll be looking at it relative to other countries. And if you recall earlier, we looked at, in the foundation area, we looked at carry and rollover. And this all links together, because with carry and rollover, we realized that actually the relative interest rates and the direction and speed at which relative interest rates are moving when we look at one country versus another is what matters when we look at exogenous analysis. Here we're doing our endogenous analysis, and we're trying to get a handle on the level of activity in the interest rate or Fed funds rate market from the Federal Reserve, and look at this in an absolute sense to get a sense of, or get a handle on, the potential for future inflation or deflation, and thus an absolute understanding of the value of the US dollar. So later in the video series, we will be looking at relative interest rates between two countries, the changes in the speed of direction, so interest rate differentials. But now we're going to concentrate on the absolute level and try to get a handle on an absolute value for the US dollar by continuing to scorecard, and to continue to scorecard in an endogenous manner. And just to cement this, a country's currency or exchange rate is affected by the central bank's interest rate policy, or in this case, the Fed funds target. Because in a low interest rate environment, money is basically cheaper. The price of money is lower. And all things being equal, a currency will lose its value due to inflation. And in a high interest rate environment, the opposite is true. Money becomes more expensive. So the price of money becomes more expensive, and money becomes more scarce. So all things being equal, a currency will increase in value. Now, what we're going to do here is move over to the endogenous driver analysis again, and we're going to go into the interest rate tab, and take a look at the monthly Fed funds rate data, which is available at the URL we pointed to, going back as far as 1954.
However, before we actually go over to the endogenous driver analysis spreadsheet again, we've got to first understand how we're actually going to analyze this data. And it's pretty straightforward. We can analyze the historical interest rate data in a very similar way to the way in which we analyze the M2 money supply data. However, we probably won't learn much by analyzing the data as a distribution. So if you look at the chart opposite, it kind of already looks like a distribution of returns in itself. So there's lots of positive data points between 1954 and 1980. And then that's followed by what seems to be as many negative data points. So by analyzing the data as a distribution, we'd probably just end up with as many moves up as there is down, and the average change would probably just be very close to zero. So the down moves would basically cancel out. So the down moves after 1980 would basically just cancel out the up moves before 1980. And also, if you look at interest rates in the recent history, they're currently at extremely low historical levels. So how do we compare rates now with, say, 1980, when they were near their peak? So the way to analyze the data is actually to look at the percentage change in interest rates. And by doing this, we get a rate of change, and we also create a base metric by which all historical rate changes can be compared to each other. And we also allow ourselves to gauge the pace or speed at which interest rates change. So we can basically identify normal situations and abnormal or outlier situations.
Okay, so why don't we go into the spreadsheet, endogenous driver analysis, and take a look at this data. So we're currently in the interest rate sheet here. As you can see at the bottom, the IR percentage sheet next to the M2 money supply. And if we go into the sources tab first, we can see on row 14, we have our interest rate source, the Federal Reserve benchmark rate, and we can click onto this and go to the St. Louis Fed website. And we can see directly on this page, we have 3 files, and we can download these files to get the data, no problem. And if you go back to the spreadsheet, we go into the interest rate tab, and we have a number of columns. The first one we have is the date, and this goes up in months. The second one is we have the value of interest rates, so the actual level that interest rates are set at, and then we have them expressed in percentage terms. We then have the percentage change in interest rates, and we have this number worked out as a percentage from period to period. We have this number expressed in a value term here. We also have GDP annualized, so quarterly GDP at an annualized rate going all the way back to 1954. And if we scroll down to the bottom, this takes us all the way up to present day to February 2015. Okay, so what we've also got is a whole bunch of charts on the right-hand side here that we've put together for you. And you can spend your own time digging a little deeper and looking at the charts in more detail to understand all the numbers behind the charts themselves. But essentially all the data does come from this data set over here. But what we'll do is just have a brief look at them. So we get a nice basic overview and understanding of what's going on here, why we're looking at things. And in this section here, to the left-hand side, what we've got is firstly the chart from the presentation. So the effective Fed funds rate from 1954 to present day. We've zoomed in on that data and we can see the period 2005 to 2015. And to get an appreciation pictorially of what interest rates have done in absolute terms since the financial crisis, we have interest rates from 2008 onwards. And in the middle section, we have the effective Fed funds rate, so the nominal interest rate, versus annualized GDP growth. So since 1954, going all the way back up until present day, we measure interest rates versus real annualized GDP growth, the growth rate. And we've also zoomed in on this data, looking at it from 2005 as well. So we get an appreciation pictorially of what interest rates do when growth rates fall. And we can see that going back all the way to 1954. And we can see that when we zoom in from 2005 and get an appreciation of interest rates relative to growth. Now, our key metric is our percentage change in interest rates month on month, and we compare this to annualized GDP as well. So comparing the percentage monthly change in interest rates. So we have that base metric that we compare all percentage changes in interest rates to each other in history relative to the annualized GDP growth rate. We have that going back all the way to 1954. And you can start to see that there's quite a lot of correlation between interest rate changes that are month on month negative, the size of those changes, the direction, and comparing it to annualized real GDP growth. We can see that there's some sort of correlation there. We can see that when we get big negative decreases month on month in interest rates, these changes tend to be associated with periods of negative GDP growth. And just for clarity, we see interest rate changes in blue and GDP growth rate changes in red. And we actually zoom into this data as well on further charts. So we look at periods like 1980 to 2006 when interest rates were decreasing rapidly. We zoom in further, 1990 to 2006. We look at the period 1980 to 1990 as well. And the final period we look at is the period 2006 to 2015. So up to present day, where we're comparing the interest rates on all of these charts, the interest rate changes, the percentage changes in interest rates in yellow versus the GDP growth rates that they're associated with at the same time in red. Now, as already mentioned, in your spare time, you can spend much further time analyzing these charts and the data behind it. All the data comes from the left-hand side of the spreadsheet. But in your own time, dig a little deeper, try to understand and learn the relationship between percentage changes in interest rates historically and the levels of annualized GDP growth rates that they are associated with at any one moment in time, and compare them across the spectrum. The general message here is that the percentage change in interest rates historically is correlated to the annualized GDP growth rate at any one time. But there is a time lag. So, for example, when there are very large percentage change decreases in interest rates, this is generally associated with a slowdown in the annualized GDP growth rate. So basically the Fed is reacting by decreasing interest rates aggressively. So the magnitude, the percentage change is greater in the negative direction. And this is associated with significant or larger than normal GDP slowdowns. And the time lag is that the percentage change in interest rates to the downside moves after the GDP growth rate has begun to fall. And the opposite holds true, generally speaking, across history, across the data, for annualized GDP growth rates that are increasing at a high pace. So high levels of annual GDP growth rates are generally associated with high percentage change in interest rates in a positive way. So high percentage change moves positively. And over to the right hand side, we have our scorecard, which we'll come on to a bit later. But what we'll do is go back to the presentation and we'll show you how to further analyze this data. And the way in which we really start to dig a little deeper and try to understand this data better, what we do is we start to filter for the extreme changes. So both the positive and the negative extremes in percentage changes of interest rates, and compare them at those times to GDP growth. And if you recall earlier in the video series, we did this in our analysis in, for example, the M2 money supply, where we filtered the columns on the left-hand side. We filtered the data for the abnormal changes in M2 money supply. Well, we do the same here. So we filter initially for negative changes where the magnitude of the change is abnormal. So here we filtered for outliers of less than a minus 15% percentage change in the pace of the monthly Fed funds rate. And these are, in history, these are extreme negative changes where the Federal Reserve has decided to cut interest rates aggressively. And what we find is that there's a very high correlation between deflationary threats and the magnitude and speed at which the Fed cuts rates. Now, when we add these up, there's basically 38 cases in the table, and in total, there's 728 total occurrences. So this is basically 5% of times. And if you recall, when we looked at distributions, 5% of times is roughly a 2 standard deviation move. So these are not very regular situations. These are not normal. These are abnormal situations that happen, generally speaking, in a 2 standard deviation event. So in this situation, we would expect that the Fed, if they're cutting interest rates extremely aggressively at a very quick pace, and if the magnitude is high, that's going to be correlated with GDP contractions. So essentially what we've got here is that we've located the data where in 5% of months since 1954, the Federal Reserve has reduced interest rates aggressively below a minus 15% pace. And we have here the GDP contraction table from earlier. And when you compare this to the periods where interest rates in the negative are greater than the magnitude of minus 15%, the percentage change in interest rates, what we see is that there's a very high correlation between GDP contractionary periods and the periods in which interest rates are aggressively cut. And if we look a little bit closer at the data, So if we look at all the cases of GDP contraction, we can see the first GDP contraction in history, 53 to 54. We see the Fed reacting by reducing interest rates aggressively, and we see an almost minus 20% pace in the reduction in interest rates. In 57, our next period of contraction, we have aggressive cuts at an aggressive pace in 1958. 60 to 61, we have the same. 69 to 70, we have aggressive pace cuts in the 1970s, the early 70s. In 1980, we have aggressive pace cuts, 80 and 81. We have in 1990, this is one of our anomalies, 1990-91, there wasn't very aggressive cuts in response to this GDP contraction. In 2001, there certainly was, and we can see that in October and November in response to September 11th. And in 2007-2009, the last financial crisis, we can see very aggressive pace cuts coming in 08-09, and even aggressive pace cuts coming recently. So what you're actually seeing here in this data is the Fed reacting. So what we were alluding to earlier when we talked about the time lag, the Fed reacting after a time lag to GDP contraction and decreasing interest rates at a rapid pace. What about if we have a look at the positive outliers? Well, we've looked at it again at a plus 15% change in the pace of monthly Fed funds rate. So in terms of magnitude, we looked at minus 15% earlier. We're now looking at the parameter plus 15% to look at this equally. And when we filter for these values, we get a similar result. We get 36 cases in the table out of the 728 occurrences, and that leaves us with 5% of occurrences. And therefore, in 5% of months in the positive outliers, we're getting the data since 1954, when the Federal Reserve has increased interest rates aggressively above that plus 15% pace. And we can see from analyzing the data that the large percentage increases in the Fed funds rate tend to occur coming out of the contractionary periods of GDP or during the beginning periods of recovery and expansion. And if we look at the data, we can see this holds true. There are a couple of anomalies. In 1953 to 1954, we see big pace increases. In 54, 55, in 57, 58, we see them in 1958 and also in 1959. In the contractionary period of 60 to 61, we see most of these increases in 61, 62, and 63. In the early 70s, this is one of our anomalies. We see a big pace increase at the beginning of a contractionary period, which doesn't really fit the trend. In 1980, we have most of these towards the end of 1980 and in 1981. Again, 1991 contractionary period is an anomaly when analyzing the data. In 2001, we don't have a big increase, so that tells us something. Basically, in 2001, there were no large increases associated after big decreases. And in 2007-9, we get our increases in 2009 and 2010, and even some recently. So you can see there's a very strong correlation here when we look at both the negative and the positive outliers, that the Fed tends to react to negative GDP, so GDP contraction, with a time lag by cutting interest rates aggressively. And then when we enter periods of expansion, there seems to be a high correlation with the Fed starting to increase rates at a rapid pace. So the deduction here really is to leave a question mark over the Fed's policy with interest rates, in that In contractionary periods, they tend to overshoot, and they tend to have to correct interest rates coming out of those contractionary periods when entering expansion. And what I want to do here is actually go back to the spreadsheet and actually show you and teach you how to do this, how to filter the data properly. So let's go back to the spreadsheet, and if we just actually zoom in here, what we do is just select the columns, go to the data section on the ribbon and click on filter, and the column that we're going to concentrate on here is column E. All we have to do, for example, is click on the filter, we go to number filters, and if we want to do the less than 15% analysis, we just type in minus 0.15, tab across, and then hit OK. And then we actually get all our data that we were looking at in the presentation. And you can repeat that process for the positive outliers as well. You can also look at different parameters, so you don't just have to look at minus and plus 15%. You can look at the other parameters as well and just find out what a normal situation is and what an abnormal situation is. Well, we've looked at the abnormal, so you can play around with the data in your spare time. You now know how to analyze this properly. So what else do we get here? Well, one thing that's very apparent when analyzing the outliers is that the Fed funds rate, so interest rates, are absolutely reactionary to GDP contractions in the extreme negative and reactionary to GDP recovery in the extreme positive. And overall, just to cement this, it basically means historically that the Fed's fund rate is a lagging indicator. It lags leading indicators and lags GDP. So this obviously begs the question that if interest rates are a lagging indicator, how are they useful in our analysis in terms of scorecarding a currency? Obviously, we want to try and predict future situations. Well, interest rates are useful to us because we can take the data and look at the data from a statistical observational perspective, and we can come to conclusions about the current conditions of the economy by looking at interest rates relative to GDP levels at any one time. And that will give us a gauge on current inflation or deflation. And we do this by filtering the data for between values. So we find the historical annualized GDP growth rates that correspond to times when the Fed increases and decreases the pace of the Fed funds rate by filtering for between values. And we basically isolate the correlation. So how do we actually do this? Well, I guess the best way to do this is to show you exactly by going into the spreadsheet. So if we go back to the spreadsheet here, you'll see that we have our column of GDP, annualized real GDP growth here. And we have all our filters still on our columns. And what we do is we take the percentage change in rates, and instead of filtering by more than, so greater than or less than, we filter for between values. And if we just pick an example, we look at minus 5% and 0%. So what we're doing here is we're looking for the percentage change in interest rates that fall between 0 and minus 5%, And we're going to look at the levels of GDP that correspond to these percentage changes in interest rates since 1954. And before I hit this OK button, it should be apparent before I even do it that there's going to be a lot of them. And indeed there is. So we look at the quarterly GDP stats, and in your own time you can do this quite easily. What you want to do is basically take all of this GDP data and work out the average. And then what that is telling you is that according to a percentage decrease of between 0 and -5% in interest rates, historically, the level of real GDP growth that's associated with those levels of change throughout history, so since 1954. And this is how we begin to actually build out our scorecard. So what we just looked at there was the parameter of 0 to -5%. So percentage changes in interest rates between 0 and -5%. And look at the associated level of GDP growth at the time those percentage changes occurred. And we mark those GDP averages down. And we start to build our scorecard out in this way. We then obviously look further at further parameters. So we look at -5 to -10%, for example, -10 to -15%. And we also look at the positive changes, so the percentage increases in interest rates as well. And we mark all these levels of GDP down, the associated levels of GDP, into our scorecard. And you can see the scorecard over here. We'll look at the scorecard in a second in the presentation, but you can see that the scorecard looks a little bit different to our previous scorecards. But we'll look at the detail in a moment. We just want to cement how we've got this full analysis of predicting inflation and deflation, or in this instance, actually gauging inflation and deflation at the current time. So we're looking at this statistical observation of interest rates versus levels of GDP growth that they're associated with. So percentage changes in interest rates and the levels of GDP growth that they're associated with. So just cementing this fully and seeing what it looks like pictorially. We're looking for the levels of annualized GDP. So in this column here, that correspond to the same time periods of the pace increases or decreases in the Fed's funds rate here. And we then take the average level of GDP from these periods to ascertain what levels of GDP growth are associated with the increase or decrease in the pace of the Fed funds rate in question. So when we sort for these between values in the spreadsheet, and then we round the numbers to the nearest 0.5% and input them into our scorecard table in order to assess inflationary or deflationary conditions and whether we should be looking to have a long or short currency bias. Now you can see, as we've already mentioned, that the scorecard looks slightly different to previous scorecards. And we can explain how this works. If you think it looks a little confusing, you'd be right. And this is because the Fed reacts when it comes to interest rates. Interest rates, as we've mentioned previously, are lagging. But what we can see with increases in interest rates, the scale is not exactly a sliding scale. There seems to be something going on over here. What actually happens is when you do the filtering process, the levels of annualized GDP growth during extreme increases in the monthly Fed funds rate are actually very low. Also, the Fed can basically do whatever it wants with interest rates at any one time. We forget that. So we tend to find with lagging indicators that we do get anomalies in data in economics. Now, we can try to analyze their behavior throughout history so we can get an idea of what may occur, but sometimes because of these anomalies, we won't be able to assign a credible score to interest rates because they are lagging. So a credible score in our overall systematic process. And when we're building systematic processes in economics, we have to look at what's right in the majority. Now, with interest rates, in theory, when the US experiences prolonged levels of high GDP growth, it's usually because of an increase in the pace of lower interest rates. And when GDP growth and inflation, for example, are above long-term average trend, the Fed begins to react by increasing rates, usually at a slow pace, then at a much faster pace if growth and inflation is too high or uncontrollable. And this is basically the Fed reacting to the business cycle. So in our scorecard, we can see that a no change, so a 0% move in monthly rates, and small decreases, so small percentage decreases in monthly rates, equate to around 3% GDP growth, which is the long-term average for the US and is pretty normal. Large decreases in the Fed rate are also associated with falls in GDP from 3% down to -2%. And here we've got two areas. We have our deflationary zone and we have our inflationary zone. But first, we look at the deflationary zone. The Fed is basically reacting here to lower GDP rates, but the damage is basically done. And it takes time for interest rate cuts, so aggressive interest rate cuts, to actually work. So here we tend to have a long currency bias because at this point in the cycle, no one really knows whether the deflation itself will continue and how long it will continue for. And then, of course, we have the second area when we have large decreases in rates, percentage decreases in rates. We have the second area, the inflationary zone, where we're predicting future inflation. So when we have the extreme decreases in the pace of the Fed funds rate, we tend to have a short currency bias. Basically, GDP growth is negative, so contractionary, and the Fed may be acting very late. So they're panicking and overdoing the stimulus by being overly aggressive in reducing rates. Now, when we look on the flip side, on the positive side, so we have positive rate moves, we have the inflationary zone here, where again, we have a short bias. And this is when GDP is between 3 to 3.5 and maybe 4%. This is basically the comfort zone where levels of growth warrant basically minor tightening in order to control growth and inflation. And on the extreme increases, as we've already highlighted, we do have this anomalous zone where high increases of annualized Fed funds rates are associated with low levels of annualized GDP growth. Now, this begs the question that if they are reacting, then why would the Fed increase rates at an extreme rate when they are seeing lower than long-term trend in GDP growth rate? Well, we have to actually look at the actual data points for further explanation. So if you filter in the spreadsheet, you'll be able to find all this data. The periods in question are basically all post-recession or large-scale GDP contraction and post massive amounts of easing rates. They're basically, on the whole, anomalies, and there's very few of them. And as alluded to earlier, when we're building out systematic processes in trading, portfolio management, and in economics, what we need to be doing is concentrating on being right in the vast majority of cases, and therefore give them a no score. So we don't give them any credit. We don't give them any score because they are basically anomalies. So this is how we build our scorecard when we're building out systematic processes in trading and portfolio management, especially when we're looking at things like interest rates, which are lagging indicators and telling us what's happening now in the economy. We have a look at the data and we scorecard as best we can in the vast majority of cases, and we do it systematically. So we stick to the systematic process. And if we have anomalies which are in the significant minority, then we just have to give them no credit. What we have to do when building out systematic processes in trading and portfolio management is basically concentrate on the vast majority of cases and being right in the vast majority of cases. So we basically just give them no credit. Now, what happens when we look at the data at the moment and we score or try to score for what is currently happening with interest rates and GDP growth? Well, a sensible approach is to take the last 12 months to see if there's any bias in the Fed funds rate. What we've done, we take the last 12 months of data and work out the average change in the monthly Fed funds rate, and this comes to 4.41%. Now, you can go to the St. Louis website and you can do this every month. You can download the data, cut and paste it here into the table that you've got in Excel, and then you can actually go into all your charts and update your charts to include this row here, and you'll see the charts change automatically, and you can continue to work this out on a 12-month rolling basis. So on the scorecard, historically, the 4.41% pace level in the Fed funds rate corresponds to around a 3% GDP growth rate, which is roughly what the US is growing at in 2014 to 2015. So the score that we're likely to give interest rates is going to be around a 0 and a no bias at this point. And one point to note here is that actually when we look at the anomalies, one of our anomalies is actually present in our current 12-month sample. And this might be because rates are actually so low right now that they can't go any lower. So we're bound to see large positive anomalies occasionally, or it could be potentially a precedent of future sizable rate increases. So that's still in question, a question to be put out there. But in our overall systematic scorecard process, there's obviously many drivers that we're looking at. And when we look at them all taken together, they should overall give us a very good indication of what to expect and what is currently going on in terms of inflationary and deflationary conditions. So what we do is we just continue to build out our scorecards and do this in a systematic and very objective manner. So let's go back over to the trading desk and we'll have a recap on interest rates.
Okay, so welcome back to the desk. That was interest rate analysis there. I know it can be a bit confusing, but we can just break it down for you here. Basically, looking at interest rates, how we analyze them, it's not a statistical distribution like M2, because we know that interest rates are reactionary and lagging. So the way we look at interest rates is we look at the percentage change historically versus the level of real GDP associated with those percentage changes at that point in time. So essentially it's a statistical observation, not a distribution, because it's not just about the level of interest rates, so whether they're really high or really low. It's the percentage changes and the rate at which they're increasing or decreasing. So the percentage changes and the rate and pace of increases and decreases associated with the levels of GDP at that point in time are actually more important than the actual level of the interest rate. And what we see is that small percentage decreases, so the rate, the decreasing rate as being a low decreasing rate, is overall reactionary to bad situations, so lower levels of GDP at the time. And in that situation, we're most likely to lean towards a long currency bias, because we know the interest rates are reactionary, but they take longer to actually begin working their way through the economy. And that's relative when we look at M2, for example, which when M2 has its weekly changes, M2 has a bigger impact or quicker impact on the economy than interest rates do. So interest rates are reactionary and slower to take effect. Then we also have the two inflationary zones. So we have the big decreases that we look at, and big decreases in the interest rate are still obviously reactionary and take time to work their way through. But the big decreases are associated with very low levels of GDP, even negative real GDP. And in that scenario, because the moves are so extreme, we're looking to have a short currency bias, predicting that inflation will be quite harsh and quite strong in the future. So we're using the interest rate moves in reaction to even predict the potential future here of inflation. And then on the other side of the scale, the positive side, as we climb up the scale, we see two areas. We see the inflationary side, where we're predicting inflation. We're getting interest rate increases, and those increases are associated with high levels of GDP. And those higher levels of GDP are kind of in this comfort zone, and we're not really assigning high scores, but we do have a short bias. And the second area, we have the anomalous zone, which we can't thoroughly explain, where we have big increases in interest rates and very low levels of GDP, but these cases are very few and far between historically. So we have anomalies that we can't really explain, and we just try our best to scorecard systematically in the absolute vast majority of cases. So those three main areas of inflationary, predicting inflation in the high cases and the lower cases, and the long currency bias, so predicting deflation in the small decreases, they're the three areas that we need to concentrate on. And interest rates just get plugged in to our overall analysis and scorecard using the static absolution principle in our endogenous analysis. And we're going to come back to interest rates much later, when we actually start comparing interest rates in one country to another. So what we'll actually be doing is comparing the United States to Australia. And this all again comes together in a much more concrete way a bit later in the video series. because here we've analysed interest rates in the way they need to be analysed in an absolute static principle or basis, by not just looking at the level, but looking at the rate of change, so the pace of the change of interest rates and the direction that they're going in. So whether they're going up and going up fast, or whether they're going down and going down fast. And that's what really matters. And later on, when we move on to exogenous analysis, we start looking at the direction and the pace that interest rates are going in that direction with two countries relative to another. And that's what really matters when we move into our exogenous analysis. So let's go over to the next video, and I'll see you on the other side for our next driver analysis.